What do you think is the implications, what are the implications then of the removal of this currency manipulator label by the US? Is it just symbolic, or is there a material impact other than the strength that we've seen in the last 24 hours or so around the yuan?
I think it's mainly symbolic. The currency manipulator label wasn't going to carry a lot of material sanctions or policy restrictions. Nevertheless, I think it's still very important because that removes at least some of these policy constraint, or in terms of bilateral communications between PBC and the U.S. Treasury and so on. This is no longer going to be a binding issue every time they talk. They can move on to more substantive issues. It also symbolizes the fact that tomorrow, when they sign the phase one deal, there's likely going to be commitment on the Chinese side for relative stability of the exchange rate.
How does that all play in then to your forecasts for the currency for end of year?
Yeah, so our forecast for this year, $CNY is around 7. So we think there will be times like right now that it moves lower than 7, so strengthens. But our view is that after the phase one deal, throughout this year, it's a very long year. It's a U.S. election. There could be uncertainties flare up again, so the exchange rate move a little bit. And also, of course, it depends a bit on dollar, euro, and other cross currencies.
Let's just focusing on that trade deal then a little bit more. We're hoping to get some more details, an 86-page report. We know the broad strokes of this agreement that is likely to be signed on Wednesday. Which sectors of China's economy are most likely to benefit on the back of this signing?
Well, so the first one, the first phase deal, the first thing is that they removed the December tariff hike, and that was mainly on consumer electronics and so on, and also halves the September tariff hike that's also on a lot of consumer goods. So consumer sectors, electronics, tech, manufacturing is all going to benefit from this. Certainly people can sigh relief and continue to produce, and the orders probably will continue as well. And it's also going to be relatively positive for the labor market because those are relatively labor-intensive sectors. Otherwise, there would have been a hit. So with that being more stable, that's also for consumption and staples and discretionary goods in China. And then, of course, there's going to be some impact on the agricultural side. In the short term, China buying more U.S. products, including meat and so on, that's going to help at the margin, probably help with the prices or inflation. In the longer term, of course, more imports, there's going to be some impact on Chinese ag sector as well.
Does the diversification of supply chains that we saw take place in 2019 continue, or do businesses start to think that actually this marginal stability in China means they can put a halt to that to some extent?
Well, we think it will continue. So actually the supply chain movement had already started before the trade war as labor costs and environmental costs rises in China. But the trade war definitely unleashed new uncertainty, there are new costs, and people worry about supply chain disruptions, especially on the tech side. So our UBS CFO surveys of manufacturing exporters show to us that along with time, even though CEOs, CFOs may expect a deal to be signed, their intention of moving away continues to rise. So we think that continues. Even though there's a phase one deal, I think that most people believe that U.S.-China relations will be challenged going forward.
We're getting trade data out later today, around 10 o'clock local time, it's expected. What do you forecast in terms of exports and imports? Are we going to start to see a bottoming out now and a revival of trade data as we look towards the second part of this year?
Well, yeah, so for the December one, there's some base effect, and there's also, some rebounding in orders. So we're looking at exports up 4%, imports up 6%, imports more than exports. And throughout the year, there's going to be, in the first part of the year, the base effect is still going to be a bit challenging. But for the year, we are looking for roughly flat trade compared to last year. Last year, of course, declined. So there's going to be an improvement.
On the PBOC, when it comes to the PBOC and the Finance Ministry, the policy mix, what will the priority be? Can they take the foot off the pedal now that we have some more certainty around the trade picture, or do you expect still relatively focused easing policy from the PBOC?
I think the policy direction is relatively clear from the Economic Work Conference, that is continued modest easing. Because of the uncertainty still remaining, and also the negative impact of higher tariffs from August and from September is still coming into play. So these policy easing is still needed. So we are still going to see some rate cut, marginal rate cut of MLF. We see more liquidity easing. We're looking for another 50 basis points of triple R cut. We see more focused, as you mentioned, fiscal easing, so more infrastructure spending.
Very quickly, your target then for growth for China for 2020, and more broadly, are we seeing a bottoming out in the growth picture in the Asian region?
Right. So, yeah, for China, we are looking for 6% this year. For the Asian,
you've revised that up.
We revised it up about a month ago when there was clear signs that the Phase 1 deal is going to be signed, and with December tariff hike removed. So for Asia, so the positive is that there is going to be no or less collateral damage coming from the U.S.-China trade conflict. And especially in North Asia, if you look at Korea and Taiwan, these are very exposed to global trade and exports, so it's positive for them, this deal. And we also have seen some signs of maybe a tech cycle bottoming, or maybe it's just China is increasing imports of tech products, so Korean exports is doing well. So signs are generally better for North Asia, and also that we think for China on the consumption side, after a year and a half of double-digit decline, the automobile sector maybe also will start to bottom.